Okay, at this point, we actually will have the special privilege to announce that we have a terrific second guest, and it's none other than Nancy Davis, who is the founder of Quadratic Capital Management and the portfolio manager of the iVol ETF. Nancy, thanks for joining us today.
Thanks for having me. It's great to be here with you guys.
So we were just going through your kind of your career, and you were telling us how you used to work at Goldman Sachs, and I was quite impressed that you were the head of credit trading and OTC trading. Is that correct? The proprietary group for 10 years, for a decade?
Yeah, as a head of credit derivatives and OTC trading for the principal strategies team at Goldman.
And so what was that like? So was that in the early 2000s, or was that like what was the timeline that you were doing that job?
Yeah, I was at Goldman starting in the late 90s, and I was had that role in the mid 2000s where I was the head of trading for that team. So.
And then you quit Goldman and you went off to and you founded Quadratic. Why don't you tell us a little bit about your firm and what you guys do, and a little bit about your product that you've launched.
Yeah, so Quadratic is an asset management firm. We're based in Connecticut. I started the firm in 2013. It's really the same investment strategy that I've implemented throughout my career, which is structuring directional portfolios with cross-asset class options. So we have Greek risk, but we're not trading implied versus realized volatility. We're taking directional views, and we're using the options to risk manage those views.
Okay, and terrific. And what is the iVol product itself? Like, why don't you just give us a brief kind of history, like not history, just kind of a bare bones description of what it's trying to accomplish?
Yeah, the iVol fund is a government bond fund, so it's a fixed income fund. It's listed on the exchange. Most people hear ETFs and they think passive index replication strategies. This is actually an actively managed ETF. And what we do is we seek to profit from relative interest rate movements, whether that's Fed rate cuts or rising long-term rates. And we provide inflation-protected income as well that is potentially enhanced above just regular government bonds. And then we're also, because we're buying options within the fund, we're also long fixed income volatility. So we have the potential to benefit from market stress as volatility increases.
So I'm going to jump in here, Patrick. When I first saw iVol, I must admit that I looked at the different kind of aspects or characteristics of it, and it was just kind of seemed like I joked about it, calling it my dream ETF because it had basically a steepening aspect. It had a real return aspect in terms of the tips, and then it also had a fixed income long vol aspect. And to me, those were three kind of very attractive characteristics because over the long run, I think all three of those trades are going to be winners. So I've followed it very closely and been a huge fan. How have you found so far? Like what has been the response, and what are the challenges that you've as a kind of an ETF manager have been pushing up against?
Yeah, I mean, I think most people who invest in ETFs are used to stocks and then credit strategies. Like there's a ton of AUM, and whether it's emerging market bonds or high yield or investment grade or bank debt or floating rate notes. But in the rates market, there's not a ton of innovation beyond just government bonds. So we're really excited about bringing, the biggest asset class to the ETF world. But the challenge with doing something new is people don't really know, where to put it. So that's been one challenge. It's a lot of education. Also being, a small new entrant to the world of 40 Act funds, it's a bit of a process to kind of get the name out there. So we really appreciate Kevin and Patrick, your support and the opportunity to be on this podcast and at least let people know to check it out and do their homework and evaluate it if it might be appropriate for their portfolio.
Yeah, one of the things that I'm most attracted to is the fact if you go to your website, the ivoletf.com, and you go to the tab that says iVol, you can go down to the thing to the top 10 holdings, and you can see what's actually in the ETF. And what you'll realize is that a lot of those holdings on the options are options that are available only to institutional investors that have the kind of ability to trade using what's known as an ISDA. And for most retail investors, this isn't something they're able to do. And even for me, that's I trade a lot of fixed income. I have the no ability to go out and basically get long a curve steepening option. And this is why your product is just so unique and something that people should really kind of have a look at, because this is fantastic. The fact that I had no idea that these things were so available and kind of so tradable. And not only that, let's talk a little bit about the opportunity in those curve steepening options. And we won't talk specifically about kind of the ones that you own, but let's just talk about why you would own an option on the curve steepening as opposed to just on volatility on the index or and fixed income as a whole.
Yeah, no, definitely. I'm excited to talk about kind of how it's made and what it does, but maybe just to circle back on your point about having it be, we really see this as an access product and a way to, bring, I like to say that, anybody can trade a stock or a bond or a listed option on their iPhone even. You don't need you could do that very easily with listed markets, but bringing the world of fixed income and an OTC product to the ETF wrapper, we see it as, you have the transparency of a separately managed account because every day the portfolio holdings are disclosed. The strategy is very clear about what its goals are and what it does. But it also gives access. I feel like we've become, I hope to become kind of like the convenience store for convexity, where we give kind of everybody access to this market, which is it's a really great time too. Obviously, it is an all-weather trade, and we, expect it to be, when we actually do have a steeper curve, it's probably when people are going to be worried about inflation and all the money printing that we've had for 12 years. But right now, with an inverted yield curve and this type of fixed income volatility is trading at about 2 basis points a day, it's super compelling.
Absolutely. And Nancy, what I find interesting as well is that when you're playing the steepener, it's also it's a byproduct of the market cycle, which is that often during a steepening, often it's associated with a recession and bear markets or even weakness in real estate. And so there's all sorts of different really interesting aspects of holding this as a hedge, not just as a play on the steepener alone, but also as a hedge for your whole portfolio. Is that a fair way of looking at it?
Yeah, definitely. I think it's because we're long optionality inside the ETF. It gives that protection against, if there is a market correction. Historically, when we've had these sell-offs, like big sell-offs in the equity market, the Fed will come in and cut rates. So that will typically make the yield curve steepen. So you get the directional wing there. Plus, it's long government bonds that are inflation protected income. So you have the good carry as you're not waiting for something bad to happen necessarily. And the neat thing about this type of, curve trade is that it also works in a risk on environment. If we do have the Fed normalize inflation expectations, and we do have a normalization of the yield curve. So it's kind of got like the tail-like properties with the income, but also if we have a super, kind of risk-on environment, it should perform well in that environment too.
So Nancy, I can't help but to ask your opinion about what you think is happening in the funding market. As we tape this, the Fed has had to come back in and do another $75 billion in repos overnight. What do you, you have a lot of experience, trading at the front end of the curve and watching all the different things. What do you think is happening, and what do you think are the consequences of that?
Yeah, I mean, I definitely think it's a really, it's sort of a flashing sign. It's a red light for investors to be aware of. Also, the inverted yield curve, the slide that you have off right now, it's historically been an indicator that a recession is coming or a recession is near. But I think of repo as the grease for the wheel. And when the wheel starts turning, that's when we have you fly over the handlebars and crash. So it's definitely maybe a bad analogy. I just made that up. But for those of you who like biking, it's definitely an unhealthy sign, and it's something people need to be watching and aware
Yeah.
about.
So I've kind of been of the opinion that it's the market's underappreciating what the concern in it. Yesterday at the FOMC, Powell seemed to dismiss it as well. Do you think the market is kind of ignoring it, and is that going to be a worrisome sign about maybe that there's too many, the animal spirits are a little too frothy, and that we should be paying more attention?
I think it depends on the asset class. Like in my opinion, the rates market is usually the first one to kind of, if you were going to say which is the smartest market, I would say it's the rates market. And the rates market is definitely, not happy, and definitely saying, the bond market is screaming that something bad is about to happen. I think the other markets, whether it's the private side, private credit, private equity, or public equities or public credit, those markets seem to be kind of humming along, like everything is
Yeah.
fine.
It's that saying of nobody cares till everyone cares, and then everyone cares all at once at the same time, right? And
Yes.
it'll be interesting to see when these other markets start to think that this is important.
And so, Nancy, the other question is about the yield curve. Do you think that with all of the distortions that are happening in Europe, with the negative rates and the hunt for some duration from European and even Japanese bond managers, do you think that there's a chance that the yield curve is broken as a sign of economic, a harbinger of what's to come, and that maybe this summer's kind of duration spike was not really a problem with the economy as much as it was just this crazy, bid for fixed income due to the absurdity of monetary policies overseas?
I know a lot of people say that and they're blaming it, but I also think if you look at global yield curves, France has an upward sloping yield curve, Germany has an upward sloping yield curve. The U.S. has a more inverted yield curve than even Japan or the UK. So I think maybe that's the case. It's really hard to say. I can't speculate, but I think it's also, for us, we see it as a tremendous opportunity for what we're buying inside iVol, because it's, basically, the real yield exposure from the tips. So we want lower real yields, but also the curve steepening, whether that happens from, hey, we're going into the next recession and the Fed needs to cut dramatically more, or maybe they're successful in, stimulating the economy and we actually have a normalization of inflation expectations.
Yeah, I'm torn because I can kind of see both sides. I see what the market's all worried about, and the fact is that the U.S. is still the tightest monetary policy out there. Yet at the same time, I see the economy, and I think to myself, hey, it's not that bad, and we're still sitting there with unemployment, at all near the lows, and yeah, the global manufacturing looks bad, but when you drill down on the actual economics in the U.S., it doesn't look that bad. Do you so for you, you don't care whether it's like the fact is whether the economy rolls over or whether it gets going. You're just more concerned about the fact is that the yield curve is inverted or very close to inverted in some cases, and that the risk reward of that trade just makes sense and it'll eventually kind of normalize. Is that kind of your thinking behind it?
Yeah, exactly. I mean, we saw a need to really give investors access and democratize the financial markets and bring new products and innovation into the world of ETFs. And we do really love the ETF vehicle because, especially in the world of active ETFs, it's has all the benefits of being a separate account. It has much lower fees. It has transparency, but at the same time, the yield curve is inverted. The type of volatility that we're buying inside the fund, it's about 2 basis points a day, which is significantly cheaper than any type of listed option vol, whether it's treasury options or some people look at equity ETFs that trade like TLT. It's much cheaper than that. And even swaption vol, which is what even institutional investors typically access. This is a 1-year, 10-year at the money swaption right now is about 4.2 basis points a day. And an at the money forward for same tenor in what we're buying inside iVol is about 1.9 basis points a day. So it's a pretty compelling time, whether you think it's going to be a normalization and we're going to have risk on and the Fed will be successful in stimulating inflation, it's a good time. Or if you think we're on the, cusp of a recession and the market's going to go risk off, either way, the asymmetry is attractive.
And the other thing I'd like to say, just for the people that I really encourage you to go and dig into the holdings, you'll notice that the vast majority of the fund is actually in what's a TIPS ETF that you hold. So it's in essence kind of the most of the principal is actually very safe, and it's just the kind of at the margin, I guess, basically 14 or basically a little more than 13% is invested in these really cheap options. And in doing so, what that does is it really offers a situation where the tips are earning a yield in the meantime. And then if the curve steepens, as both you and I hope, Nancy, that payoff will kick in at that point. And I encourage people to go look at it and understand that, because it sounds scary. It sounds like, oh, geez, it's betting on interest rates and curve steepening, but it's not actually as scary as it seems. And I know I'm not going to ask you to comment on that, Nancy, because I don't want you to be forced to talk about the risk return, but I do want people to go, and I do encourage them to go learn about it, because it really does offer a very unique, interesting vehicle.
Yeah, no, thank you for that, Kevin. We do see it is a government bond fund, and then it has an enhancement. And I think in terms of portfolio construction for investors who already own U.S. inflation-protected bonds, TIPS, this is just an enhanced portfolio, and we see this as enhancing with options that are on inflation expectations. And so if you like, tips, why wouldn't you want to have these options that are, the expectations, which are priced in, with such negative, it's priced for disinflation for the next decade.
Right. Makes sense.
Well,
Yeah.
Nancy, I just want to thank you for coming by. It's a pleasure getting to know you and telling us about your product. Why don't you just tell people where they could find more information and let people know where they should go?
Yeah, I mean, feel free to email us at investor.relations@quadraticllc.com, or there's a contact us on the fund website, which is www.ivoletf.com. And we'd be happy to take any questions. And it's also in Bloomberg. It is an ETF, so really anyone can access this unique market.
That's right. So again, it's iVol. If you want to trade it, it's iVol on the New York Stock Exchange. And Nancy, it's been a pleasure having you and meeting you. Thank you very much for your time.
Thank you, Nancy.
Thank you, Patrick and Kevin. It's been a real pleasure. Appreciate it.
Take care.
Take care.
Thanks.
Thanks.